Successful investing means working towards both short-term and long-term financial goals. So how do you build a profitable portfolio that's designed for you? And how do you do so without having a shotgun portfolio, which can be so bad for your investments? And it's something I'm going to cover later in this video. Hi, my name's Kerry Green, and I'm a financial advisor and the co-founder of Green Era Financial, a registered investment advisor based out of Florida and serving clients nationwide. We specialize in investment management and financial planning, including custom portfolio design, which is a topic I want to go over with you today. So let's start off with what an investment portfolio is and what it should look like. Simply put, an investment portfolio is a collection of assets you buy to generate income or capital appreciation. This could include CDs, money market funds, stocks, bonds, ETFs, mutual funds, real estate, crypto, art or collectibles, gold and silver, etc. Generally, a portfolio is going to include more than one account, such as IRAs, 401ks, brokerage accounts, high yield savings accounts, etc. In order to build a proper portfolio that's tailored to you and your finances, there are 4 basic steps you need to follow. Step 1, start with your goals and time horizon. The best way to do this is sit down and list out all of your financial goals. This could include buying a home, taking that dream vacation, funding your kids' college, or really having a great retirement. The next thing to do is to set a time frame for each of these. When do you want to buy that home? Or when do you plan to retire, etc.? From here, you should sort these goals into 3 categories. Goals that you want to accomplish in the next 1 to 3 years, goals that fall into the 4 to 10 year bucket, and goals that are for when you reach your retirement age. And that brings us to step 2, understanding your risk tolerance. Now that you know when you'll need money for each of your goals, this gives you some insight into how much risk you can tolerate for each of these. Generally, the longer the time horizon, the more aggressive you can be, since you have some time to recoup short-term losses. Whereas short-term goals generally require a more conservative strategy, since you likely can't afford to lose what you have saved. That being said, there is a fine line to walk here between how much risk you should take and how much risk you're willing to take, considering risk tends to go hand in hand with potential reward. Now, one trick that can help with this is to assign a number from 1 to 100 for each of your goals, 1 being super low risk and 100 being maximum risk. Now, once you've got that done, that brings us to step 3, which is matching goals with the various account types. Before you get into picking investments, you need a place to put them, and ideally the right place for them. So here's the simple rule of thumb. Tax-advantaged accounts like IRAs and 401ks work best for long-term retirement-related goals and can accommodate any risk tolerance. Taxable brokerage accounts work well with those goals in the mid to long-term range, where you probably want more potential upside than a savings account. High-yield savings accounts, CDs, and money market accounts work best for those short-term goals of less than 3 years, where you want a little bit of growth, but you also can't afford to lose money. Now, once you've matched your goals with the various account types, that brings us to step 4, selecting your investments. Now that you have your goals, time horizon, and risk tolerance figured out, it's time to put that all together in a cohesive portfolio. So let's cover the basics here. Stocks are units of ownership in a publicly traded company. You can buy shares of thousands of companies based in the US and abroad. Stocks tend to be higher risk, but also offer a greater chance of growing in value than some of the other options. Now, bonds basically turn investors into lenders. Buying a bond allows you to lend money to a company or a government. In exchange, the issuer of the bond pays interest on your loan until they repay it in full. Bonds are typically less risky than stocks, but there's also higher risk bonds like junk bonds. Now, if you want to spread out your risk between multiple stocks and bonds, you can invest in things like ETFs and mutual funds. These are basically baskets of investments. When you buy shares, you end up owning a little bit of everything that's in the basket. Now, with ETFs and mutual funds, your risk will vary depending on the fund that you invest in. Now, there are also investments in cash and cash alternatives. These are things like CDs, money market funds, savings accounts, etc., which offer a low-risk place to set aside your money and still earn a small bit of return. And then there are alternative investments. If you can dream it, you can probably invest in it. From precious metals like gold and silver to real estate, crypto, art, watches, collectibles, etc. But caution, alternative investments are often higher risk than stocks and bonds. After you decide what type of investments you want in your portfolio, it's time to decide how much of each you should buy. While you might be tempted to throw every penny into high-risk stocks or investments, this is the part where you really need to keep a cool head. This is something we call asset allocation, and it keeps you from putting all of your eggs in one basket by helping you to divvy up your money where you still get to enjoy returns that make sense for you, but helps limit losses. losses. For example, if you have a high risk tolerance and a 30-year time horizon, you might invest 90% into stocks and 10% into bonds. Whereas someone with a moderate risk tolerance may choose a portfolio that's 60% stocks and 40% bonds. Once you've decided on an asset allocation for your goals, you can then look at the next piece of the pie, diversification. Diversifying your investments helps mitigate risks and volatility. So it may be smart to take that 90% you have allocated to stocks and split it up between large and mid-cap stocks in a number of different industries, such as energy, industrials, technology, to name a few. And it's key to also look at how you can diversify all of your investments to each other, such as stocks, to your bonds, to your real estate, etc. All right, now let's talk about the shotgun portfolio I mentioned at the beginning of the video before I give you my final bonus tip. The number one issue I see when reviewing people's investment portfolios is that it's like they invested by shooting a shotgun off at a wall of potential investments. They have 5,000 shares of this and 10K in that and 100 shares of that fund, etc. And there's no cohesive whole to their portfolio. In fact, it's not even a portfolio, it's just a random smattering of different investments. This makes risk management, asset allocation, and diversification basically impossible and can cost you massively in long-term results. So again, I caution you, do not adopt a shotgun portfolio approach, but instead build one that you nurture and take care of and build that structure and then stick to it. And then lastly, I have a bonus tip for you. It's extremely important that you monitor, rebalance, and adjust your portfolio. Once you hit buy on all of your investments in your portfolio still needs some TLC after that. It's worth checking on your portfolio once a quarter or twice a year to ensure that your asset allocation is still aligned with your goals. You also may need to rebalance some of your holdings as the market can be volatile and some of your holdings may have moved up or down. Additionally, as time moves on, those midterm goals will become short-term goals, and so those funds need to be adjusted in what you're investing in as needed. And to top it all off, if you have any major life changes, you may need to revisit this whole thing all over again. Getting married or divorced, having kids, receiving an inheritance or large windfall, getting close to retirement. These are all major life events that would necessitate sitting down and rethinking your strategy. And remember, the best investment portfolios are a lot like a garden. With regular care and attention along the way, it should flourish. I hope this helps you understand the 4 steps to building a profitable portfolio. And please don't hesitate to reach out with any questions, or if you would like help with a review of your portfolio, you can always use the link in my bio to connect with me anytime.